Today we're going to talk about where capital gains tax, or CGT for those who like acronyms, fits in when it comes to property investment. Hi, I'm Jeff Banks, the founder of Banks Consultancy, not your ordinary accountants, and today I want to dispel some of the misconceptions about CGT and where and how it becomes part of the tax that you pay. Capital gains tax is not a tax itself. A lot of people seem to think that it's a separate tax levied on things like property transactions. Others think CGT applies to all property transactions regardless of the period between the purchase and sale of the property. So let's run through some of those misconceptions. Misconception 1. CGT is a tax. Actually, the capital gains tax legislation is a method of calculating how much income is included in your tax return, and then primary taxes are levied on it. So not actually making it a tax, but more a calculation of what to include in your tax return. Misconception 2. CGT applies to all property transactions. Properties, like all commodities, can be bought and sold. If you're in the business of buying and selling properties on a more commercial basis than just a plain investment basis, then the tax department could construe that because you're a business, that even though the relevant time periods embedded within the CGT legislation could apply, they would not apply, and that you are just there to pay revenue tax on the profits that you make. Misconception 3. The CGT rate is 46.5%. As I said in the first misconception, CGT is not a tax in itself. It is merely a method of calculating the amount to include in your tax return. So when you've made your calculation, your taxable income is less than potentially the lowest marginal tax rate, then the amount of tax that you pay on your capital gain is actually nil. Now, obviously smart, savvy investors and business people will be making significant amounts of money from their property, business and other transaction, and as such, they'll be pushed well past the taxable income of $180,000, in which case then, yes, the amount of tax which you pay on your capital gains will be at the top marginal rate of 46.5%. Misconception 4. I hold a property for more than 12 months, therefore CGT rules apply. Again, if you're in the business, or it can be construed that you are buying and selling properties in a business-like manner, then the 12-month provision of the CGT legislation will not apply. Misconception 5. I can roll over my capital gain into my super fund and pay no tax. Now, there's no one answer to this question. Some capital gains can and some capital gains can't. There can even be certain circumstances where the structuring of a gain can be made to look like a gain that could be rolled into your superannuation fund, but you need to be very careful, ensuring the transaction is set up right before it happens. Misconception 6, and this is a real important one. I can use my 6-year personal place of residence exemption to avoid capital gains tax on my rental property. Now, whilst on the face of this it seems a valid method to reduce tax, one must remember that the period you use the exemption on that rental property, because you originally lived in it, has to be then transferred to your present principal place of residence, and that there could be a CGT implication on the sale of a property which was never ever rented down the track. Misconception 7. I can use my company to limit CGT to 30%. Companies are, in my opinion, the wrong place to have residential property investments unless there's an underlying protection issue. Over time, you'll end up paying significantly more tax on the profit made on a property transaction that originated in a company structure than if you had it just in your own name. And all that is to do with company profit results, the way we project dividends, franking credits, but that's a subject for another time. Misconception 8. My principal place of residence is never subject to CGT. If you use some or all of your home as an office or in some way for business purposes, then the implication is that that property in some way is commercial and CGT could well apply to the sale. We talk to clients long and hard about whether the short-term gain of a tax deduction for a home office is worth a long-term pain of a CGT-related tax bill. Like all good business people, any proposed transaction will have considered CGT and its implication into the transaction. Talking to a proactive accountant before entering into a transaction can save you significant amounts of tax in the long term. Okay, that's enough today for me. I am Jeff Banks from Banks Consultancy, and we are not your ordinary accountants.